Okay, good afternoon, ladies and gentlemen. Thanks for coming on down today. It's good to see you. We got a little bit off schedule with the companies, but there are some important questions you just got to ask, and I figured it was worth hearing the answers. And that ties into the subject that I'm here to talk about next, and that is due diligence at depth. We also had a little bit more on notes from the field on schedule, but we're a little bit off schedule, so I'll combine a little bit of the two here and bring in more observations of notes from the field, kicking rocks with our basically 8 Ps, the due diligence. How many of you have read the 8 Ps and are familiar with the 8 Ps? Anybody not know, or let's rephrase that. Anybody not know what the 8 Ps are? 2 hands. Okay, that's not bad. The 8 Ps are Doug Casey's almost patented method for evaluating resource stocks, how we do what we do. It's the formula is not the right word. It's the method of our due diligence process. Let's see if I've got the right button here. Maybe this is forward. Okay, 8 Ps, resource stock investing. When we do our due diligence, this is what we do. We cheated a little bit with financing, but I'm not going to take credit for that linguistic twist. It pre-existed me in the company. And we'll go through these one-on-one. If you've ever seen a picture of a geologist, I've got one coming up. The first P is people. And a geologist vest, it's this thing with a million pockets, all kinds of gadgets. So going back, if in this vest, these are the tools, intellectually speaking, that we have for evaluating a company. First P is people. And we've said this many times, and it's pretty straightforward. You don't want to do business with somebody that you can't trust. That's obvious, it's logical, it makes sense. But I want to stress it again, and I'll probably stress it again and again, because you can't stress this enough. You get very excited about a great drill result. You see a press release and a stock jumps 50%, 100% in a day, and wow, you want to get in on that story. But you have to start with the first P. And if you can't trust the people, even the best rocks in the world, high-grade, wonderful rocks, the wrong people can screw them up. I promise you, the wrong people can screw up the best rocks. The project with the most technical merit can still go completely wrong with the wrong people. So you have to start with the people. And you may recognize some of these people. There's Andre up on the right. I'm not sure if I know how this laser works. There we go. That's Andre Gaumond, who just talked to us about Virginia. A serially successful guy, just technically highly competent. We have a great deal of confidence in Andre. This is Ross Beatty, who will be speaking this evening. And I mentioned the Geologist Fest. This is Ron Peratt. He's president CEO of Renaissance Gold. Formerly, it was AUEX Ventures. It was a big win for us in the portfolio. All of these guys, they look like this when you see them, but this is how they work. Well, I'm not sure how much time Ross actually spends with a hammer in his hands anymore, but he knows what he's doing, and he does go out, and he does do his own firsthand due diligence. But when I go out and I look at people, this is one of the things I look for, are these guys suits, or are they the real deal? And look at the rock hammer here. This is a well-worn, a well-loved rock hammer. It's seen a lot of rocks. When I get out of the Jeep with these guys and the geologists don't have hammers, if I had a clipboard, that would be a red mark on the clipboard. Mentally, there's my clipboard. If the geologists don't have rock hammers, well, okay, they're touring me around. Why do they need a rock hammer? Well, the geologists who make these kind of discoveries, the Andre Gaumonds, was everybody here this morning when Andre spoke? He's so excitable. I don't want to make any jokes about Frenchmen, but he was so excitable. He's telling you about what they're going to do and so on. And geologists are like that. They love these rocks. And you can't stop them from hammering on the rocks. It's kind of like, okay, stop banging on the rocks and tell me what you're seeing now. And the ones who really get it, geology is not easy. You have to understand the chemistry, you have to understand the physics, and most of all, the world-class geologists, the guys who really find the goods for us, they have to think in 3 dimensions. They have to think not just of what do I see, they have to think of what's invisible in the earth and how did that happen and what could have happened. How did it twist? How did the fault break it, shear it, bend it, deform it? They have to put all this together in their heads well before we get to see the nice 3D model on Corebox. And so it's the guys who are passionate and excited about it. I can't stress this enough. If there's a note from the field that I bring back, the people thing, it really is first. This is not rhetoric. I absolutely pay huge attention to this. And so somebody just asked me a question now about our last presenter, Guyana Goldfields. And the question was, no offense to anybody still here from Guyana, do you believe that? Are you satisfied with those answers? And because I've been out in the field with them, and I've seen them, and I've seen the work they've done and how they've done it, I can say I have a high degree of confidence in the technical abilities of these guys. And if they say they can do these things, I'm inclined to believe them. My concern is, will the market believe them? We'll see. But I think the guys they have the right people. Okay, so obviously if you have the good people, you need to have the right rocks. You need to have prospective rocks to work on. And how many people were at the Cambridge House conference in Vancouver just this last month? This is a little bit repetitive, not quite the same. A few hands are up. The key point that I drove home in that one was consistency. Whatever kind of deposit it is, whether it's veins, whether it's a disseminated porphyry like Caspice, whether it's a vein system like Eleonore that André Gaumond has, consistency is absolutely the key. Consistency of drill results, consistency in grade, consistency of ability to deliver results, all these things matter a whole much. And I mentioned when we talked about Virginia, how Goldcorp came along and bought this thing from them, the Eleonore deposit, for $750 million with no 43-101 report on it. That's really striking. Well, how did that happen? Was Goldcorp off its rocker? Were they drink too much that day? No. The reason why it happened was because every time Virginia came out with a press release, they'd do a fence of holes, and boom, 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 everyone in a row, consistently, 5, 10, 15, 20 meters, 5, 10, 15, 20 grams. It was consistently high grade over substantial mineable thicknesses, every hole, boom, 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 boom. Every hole in the fence would do it. They'd step back, drill lower, do another fence, same thing, boom, 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 boom. Step back, drill lower, do it again, same thing. It was so consistent that even without the qualified person signing off on the 43-101 report, it was obvious that the resource was going to be there. It was going to be big, it was going to be high grade, and kudos to Goldcorp for stepping in before the official report. They were sort of the speculators stepping in before everybody knew. You kind of knew, but you didn't really know for sure, not officially, and they were willing to take that risk of doing it earlier on. So some specific things that you can look at, and the drill results are the most important aspect of the consistency on the property, is you can look at, I think, we're running out of batteries here. We can look at the drill logs on the, if it's not in the press release, it will usually be on the company website. And if they don't publish drill logs, you can ask them for them. And at some point in the technical reports, the 43-101 reports, you can get drill logs. And you can look through the intervals. There was a big flap not so long ago about, there was a big flap about Bayfield Minerals drill results, and they were accused of smearing the drill results, some high-grade results out over a large intersection, and there was a big upset over that. You can see these kinds of things from the drill logs. And many of the companies will publish these with the press release, and that will get skipped over in many cases. Most people, their eyes glaze over when they look at these tables with all these numbers. But if you're looking for consistency, this is where you want to see it. You want to see that if there is 100 meters of mineralization, that it actually is 100 meters of mineralization, and not 2 meters of really high grade and 10 meters of nothing, and then 1 meter of a blip, and then another 5 meters of nothing. Does that make sense? This is an interactive session here. This is not a PowerPoint that you can't interrupt. You won't throw me off. If you have a question, please raise your hand or shout it out. It's a bit dark out there and these lights are in my eyes. So these drill logs are where you can look and see, is there consistency in these results? Not just between press releases, but in the drill hole itself. And then ultimately, when you're starting to have enough drill holes into a project, you get a 3D model out of it. If the company has their drill results plugged into the CoreBox utility, this is, if you look at corebox.net is the web address. A lot of companies, it's a service they pay, and around PDAC time, you get a lot of models, a lot of information put into CoreBox. It's a really handy little tool where on your computer you can just go to this website, you can type in the company name, or they may have a link from the company website to CoreBox, and you can see the 3D model. You can see the drill holes, you can see the mineralization around it, you can rotate it, you can zoom in on areas, and there is something about seeing things not just in 3D but in motion that really helps you to see how consistent something is. Have you ever looked at something through a screen porch or a metal screen or another screen of any kind? You can't see very well, but if you move your head a little bit, you can see the thing on the other side more clearly. Has anybody had that experience? You know what I'm talking about? It's the same thing when you take a 3D model and you move it. If you rotate it or you look at it, move your head a little bit, get some parallax, you can start see how things line up. Oh, look, there's a chute here. These are the kinds of things you're looking for. And when you want to know, okay, well, this is all technical, I don't know the details, is this really going to work? This consistency question on the property is really where it's at. When something is going to be a mine, when it has that almost intuitive feeling, when I have that feeling, it's going to be a mine. This has all the ingredients. This is where it comes from. It comes from the consistency. And is there a drill hole here and then another one here, but the one in between had a blank? That's not consistency. That's not what I want to see. This is what separates the wheat from the chaff. This is what makes a property of genuine merit. There are a lot of technical differences in the metallurgy. We can talk about all this stuff, but if there's nothing else you remember today, when it comes to the property, the second P, consistency is absolutely the most important thing. And actually, this applies to the people too. If they're changing their story all the time, if it's shifting, then you're talking with a used car salesman. If you get that feeling, run the other way. Okay, so for vein-type deposits, what I want to see is consistent 1.5 meter grade at good, 1.5 meter thicknesses at good grade. If it's less than that and it's very high grade, it can work. And particularly if the mineralization is the right type. I won't get into all the details, but there is something called resuing where you mine next to the mineralization, and then if your high-grade ore will basically separate off the host rock around it, you can just take the ore, and you can mine narrower widths that way. But it has to be the right type of mineral to do that. Not all minerals are amenable to that. So for mechanized mining, which is what lowers your costs underground, you really need at least 1 meter, 1.5 meters to get in there and be able to mine at good cost, low cost. So I want to see consistent grade and thicknesses over 1.5 meters. When people report some high-grade interval at 50 centimeters or even 20 centimeters, I've seen press releases from companies that have these narrow intercepts of high grades. You have to ask, well, is that mineable? And if somebody's going to report something of less than 1 meter, I basically, in my mind, I just average it out. Okay, what would this be at 1 meter? And if it's 400 grams at 20 centimeters, well, that's 80 grams over mineable widths. That's not so exciting to me. If it's kilos at 20 centimeters, okay. we can average that out. We can work with that. So that's what I want to see. I want to see consistent results of mineable widths. You want to see strike length of the structure. There's an old saying, you drill for structure, drift for grade. What that means is since veins are narrow and they tend to pinch and swell, it's hard to drill the entire thing off to define it. If you remember Guyana up here just a moment ago, they talked about 365,000 meters of drilling to get to where they are in their deposit. And if you remember Caspice, Yale Simpson was up here, and he said that they had, what did he say? It was something like 60,000 meters, I think. I've forgotten the number off the top of my head. But it was like 1/5 of what the Guyana guys in their deposit at Caspice is 10 times larger. Why is that? Well, it's because it's a big disseminated body. It's not a vein system. It's a big disseminated body, and you can put drill holes 200 meters apart that keep hitting the same stuff and say, okay, those dots connect. We'll get to that. So with the veins, if I have consistency of the veins that they're hitting of mineable thickness, and I have known strike length, then I can feel confident that there was a good chance the dots will connect. That when they get underground and they actually drift along the vein, that it will be there. Does that make sense? Drill for structure, that is it there? Drift for grade, how good is what's there? okay? Vertical consistency is very important because many vein systems are what they call epithermal. What is epithermal? Well, what's your epidermis? It's the upper layer of your skin, right? It's the thin upper layer. The epithermal veins, an event, a boiling point where these fluids with minerals come up through the earth, they boil, the pressure comes off, and they drop all the metals. That boiling zone in that event usually has a vertical extent of 200 to 300 meters. So if you have a single event and you find something, you have only that much vertical extent. So suppose you find a vein and it's a single event vein and you've got the top of it. The best case scenario is 200 to 300 meters down and then you're done. If you have multiple events and they're all at the same height, it might be very rich, but still only 200 to 300 meters. If you have multiple events at different heights, then you get some of these big, deep things, still epithermal, like Guanajuato in Mexico, where you can have a kilometer depth vertical extent, but it's because there are 6, 7, 8 events all happening at different levels in there. So look for vertical consistency to get real size potential, because once you've built your infrastructure, you can't move it. So what really opens these things up is vertical extent. So you want to see signs of multiple events, or if it's not epithermal, if it's what they call mesothermal or orogenic, some of these things go way deep. The kind of deposits that Andre was talking about in Quebec and Ontario, these things, basically, they're almost bottomless. The mineralization doesn't run out, the mining technology runs out, the cost runs out. Okay, so it's funny that Andre mentioned this. This was a slide I planned earlier on. This is an example of Leonardos drill results, and you can just see how consistent they are. They step back, boom, they hit it again. They step back, boom, they hit it again. Oh, here we go. All right, for bulk tonnage, different kinds of things we're looking for. Veins pinch and swell. And so if your vein grade or thickness varies a little bit in between, that's not necessarily a danger sign, as long as it's consistent over the strike length. But with a bulk tonnage project, it's a big problem if you have blanks in between drill holes. It's not supposed to be that way. Or if it is that way, you either end up breaking your deposit into separate parts, which raises the cost, or you end up with a lot of internal waste, which raises the cost. With bulk tonnage projects, it's all about margin. So anything that tweaks your cost even a little bit can actually kill your mine. So we want to see cross-sections, not just drill results. We want to see cross-sections where things look consistent across the cross-sections. And I'll show you an example of that in a moment. Obviously, there are a lot of costs that go into these. One of the big ones to think about is the strip ratio. We talked about this a little bit in the current issue of the International Speculator. Your best mine, I call these polite deposits. Your polite deposit is a hill. And ideally a hill not in a mountain range, but a hill in a flat place where you can put a leach pad right next to it and move the hill from here to here, drip cyanide on it, and get gold out the bottom. Those are the best. Most of them aren't like that. Sometimes you're lucky enough to get a hill, but the next thing over it is empty space or another mountain, and you have to deal with issues there. The worst ones are narrow ones that go down, and then you have to go underground mining on them. So you want a low strip ratio, and this is the first and easiest thing to look at of all the technical things. Just think about the geometry of the deposit. If it's a hill, it's obviously perfect. If it's an upside-down triangle into the ground and you're going to put a pit on it, it's the same shape as the pit. You have a very low strip ratio. But if it's a column, if it's a pipe, like remember the Guyana Goldfields drawing with that pipe that went way deep, obviously you can only open pit the top part of it. And after that, you'd have to move the world to get at that mineralization. So look for the geometry, look for the shape there. And then metallurgy is very, very important. And this is a big topic that can get very complicated. There are a lot of variables there. But what you want is high recoveries, obviously, and you want to watch out for nasties. You want to watch out for things that a smelter will penalize you for. If there's too much mercury or arsenic in there or other things in there that the smelter can penalize you for, or that cost a lot of money. Now arsenic is often a big red flag. Now, Yale was just up here talking about Caspice, and he mentioned, oh, we're going to put the roaster here to get rid of the arsenic. Think about this. That roaster is going to cost $250 million. So if you have a project that's worth $1 billion, a roaster at $250 million is a big deal. Now, so what I'm saying is size matters on this. If you've got a small deposit and it's got nasties in it, you've got a big problem. If you've got a huge project, 40 million ounces like Caspice, then you can actually afford to pay for that roaster. And obviously different sizes, different things. But so all of these things need to be taken into context. A lot of them take some technical knowledge, but if you apply common sense, you can actually get somewhere on your own with this without being a geologist or an engineer. And so if you think about what it's going to take to deal with something like the arsenic, it's going to cost more to get rid of this. Obviously, you want a richer, higher grade, or larger deposit to deal with that. You can overcome almost any negative with enough grade and size. But if you've got a large, low-grade project, the more issues like this that come up, the less likely it is to go ahead. Things to watch out for. So we talk about consistency, continuity. One of the ones that I loved a lot, it was a big win for us in the portfolio, was the Camino Rojo discovery that Canplatz had. This was another one. It was like Eleonore, but in a bulk setting where they drilled something and they got this long couple hundred meters of constant mineralization. And you can look at the drill logs and see it. You know, it's consistently mineralized. They step back, boom, same thing. They step back, boom, same thing. They step back, boom, same thing. Okay, here finally it starts to go a little bit deeper. But these holes are like 100, 150 meters apart, as I recall. Some of them were 200 meters apart. And each one hit the same thing consistently. It was a thing of beauty. And as they started to define this thing, remember we talked about the geometry and the shapes. It became evident that most of this ore body was in the shape of an upside-down pyramid. It was a triangle going down in the ground. The exact same shape as an open pit. So you had good grades, you had consistency, and you obviously were going to have a very manageable strip ratio with the shape of the thing. It started to look like a mine from the beginning. Does this make sense to you guys? I'm asking that a lot because I'm being a little technical, but these are the things that I look for. And notice that you don't have to have a PhD to figure this out. I mean, anybody can see that these kind of consistent results add up to tonnage, and if you start thinking of the shape of it, you can see about, anybody, a layperson can see about the strip ratio, what the potential is likely to be. About deposits, go big or go home. This is one of the wisdoms of the Explorers League guys that we work with here at Casey Research a lot. One of the first lessons I learned, this is me in my winter phase with longer hair. This is the Yanacocha gold mine in Peru, one of the largest gold mines in the world. Those trucks behind me that look like mice are those big 300-ton haul trucks, some of the biggest trucks in the world. This operation is so big, and they have the fleet of equipment. Remember what I said about margins. Everything depends on margins. They actually built gantries like NASA has to load the astronauts into the space shuttle, or did. And they have the drivers ready when they change shift. The truck comes in, stops, and the first driver jumps out one side, the other driver drives in the other side, and off the truck goes with just a few seconds stop. Now, this may seem a little extreme. You're going to build all that just to be able to change drivers in a second. Well, this truck is 50 feet tall or whatever. It actually takes the driver 5-10 minutes to climb up there, get situated, and the other guy to get down. If you've got 100 trucks, you multiply the 5-10 minutes per shift change, 2 or 3 shift changes per day, 365 days per year, you're actually spending weeks of man hours not mining or not using these trucks. So yes, it's worth it. Go big or go home makes all sorts of things manageable. I could probably talk a lot about that, but I'm going to keep on schedule here. So size is important. Grade is obviously important. This picture comes to us from Quebec. Again, this is a piece of, if you want to know what kilos per ton looks like, that's what it looks like. A nice high-grade sample there. So what is grade? What's good grade? These are very rough figures, and you know, your mileage may vary, but just as a broad guidance, if you're in an open pit scenario, anything under 1 gram per ton or gold equivalent, you can translate from copper or silver, whatever. Anything under 1 gram is low grade, and you really need things to work. You really need good metallurgy, you really need a good strip ratio. Everything else needs to be right dialed in for these to work. If you've got 2 grams or higher, In an open pit, that's really good. So it's interesting to hear the Guyana guys, you know, they talk, you've got this pipe that goes, you know, they've hit it 3 kilometers down and it's still consistent. It's very sexy. But it's actually the open pit part of the mine that pays most of the money. At plus 3 grams in an open pit scenario, you can actually overcome a lot of strip ratio. You can overcome a lot of metallurgical issues, which they don't have, thank goodness. So that works out really well. For underground, anything under 5 grams, things need to work right. You need to have good economies of scale in your mining. You need to have good metallurgy and so on. Above 5 grams, you have a little bit more wiggle room. Above 10 grams is considered very high grade. That pays for a lot. And bonanza grades, ounces per ton in either scenario. Obviously, when you have ounces per ton, you can go almost anywhere. The, not the SNP, the Eskay Creek deposit in British Columbia was famous for having a 1 ounce per ton cutoff grade. You heard guys talk about 1 gram per ton cutoff grades. These guys had a 1 ounce per ton. What that means is you had stuff that was grading 29 grams per ton gold going out into the waste pit, into the waste pile. And it didn't even process it because it wasn't high enough grade to pay for that remote location at the time. Okay, mineralization types. This has an impact on your processing. We've heard about oxide and sulfide. We heard a lot about that very specifically. The Caspice project talked about today. What you generally need to know is that oxides, you can usually heap leach them, drip cyanide on them, and get the gold out the bottom of the pile. That's very low cost processing, the lowest there is. So oxides are good. But obviously the oxidation, you know, only goes down so far from the surface of the earth, and below that you're in fresh rock, which is usually in sulfide mineralization. Sulfides are not necessarily bad. Don't get scared by the word sulfide. Some sulfides will actually heap leach. The problem is if your gold or silver or whatever you're getting is with the sulfides, that's okay. If it's in the sulfides, that's a problem. We have a picture of this right here on the right, the black and gold thing. The gold is surrounded by pyrite. You see what I'm saying? This is what they call refractory ore. And when the gold is actually surrounded by the pyrite, it's in the matrix of the pyrite, you've got to get rid of the pyrite. You've got to crack it open, you've got to get it out. One way to do that is to force oxidize it, and that's why he talked about roasting the ore at Caspice to deal with some of your sulfides. So to contrast, this is an open pit I went to in Mexico. See how red and orange these rocks are? The rocks were really busted up. The meteoric waters from the surface were able to percolate down, carrying lots of oxygen, and basically rust the pyrite. Pyrite is iron sulfide. Iron, when it rusts, looks red. That's rust. So when you have oxide ore, it tends to look like this. When you have sulfides, they tend to be sparkly. They're very pretty. I like to take the sulfide rocks home to my daughter. Tell her not to eat the lead ones. But you have to work more on them. So don't be afraid necessarily of sulfides, but ask when you meet these guys out in their booths and they talk about the ore, is it refractory? If they tell you they've got sulfide mineralization, ask them if it's refractory. That's a key question. If it is, it has to be really high grade to pay for that processing. If it's not refractory, then there are lots of different possibilities. You may actually be able to heap leach it. That's very rare. In most cases, you can just grind it up and then flow to concentrate, and we'll look at that. So heap leaching. This is a picture of the Ocampo mine in Mexico, and you can see this here is the heap pad. They took a valley, they lined it with plastic, they pile up the rocks. You can see these conveyors going up here. It piles up the rock, and you spray the cyanide solution, and then down here behind this hill, there's a couple of artificial plastic-lined lakes where the solution trickles out the bottom carrying the gold. You can process a mountain of ore very cheaply this way. That's why oxides are so fun. If you have sulfides, you usually have to grind them and then flow to concentrate. You hear these words bandied about in our press releases. This is what it looks like. This is the Chirano gold mine in Ghana. I was there in 2006 when Redback had just built this mine. These things are 25 feet tall ball mills. They're about as big as they get. They grind up the rock, and then over here they're floating the results. And what does that mean? Well, it literally means floating. These bubbles over here, a German guy discovered 100+ years ago. Maybe he was a miner washing himself after working or something, and the bubbles had little sparkly bits of the sulfides floating on them. And it actually turns out this is basically soap bubbles. Depending on which sulfide you're after, you alter the chemistry of your bubbles. But many of these things will stick to the bubbles, so you can grind up your rock, put it in a tub full of water, blow bubbles through it, and your mineral, your pay dirt, will actually float to the top. So yes, lead balloons do float in our business. So that's how you recover your sulfides. And then this, you dry it. You can sell the concentrate as is to a smelter, or you can process it further if you want to go to doré. Infrastructure is very important in terms of the property. This is the now flooded, unfortunately, Goldex mine at Agnico Eagles. Notice it's in the town. These are houses all around here. This is a highway, a Canadian highway going by here. The reason why I like this picture is it just shows your infrastructure advantages. This tower here, there's another one just off the picture. I don't know if you can see it very well. They built this. This was an underground mine making lots of money at 2 grams per ton gold. So it just goes to show there are exceptions to the rules. And economies of scale, and it was really the infrastructure that made this work. It was very low cost. There was an existing infrastructure there. All they had to do was up the size so they could get the throughput to bring the economies of scale to bear, and they were able to mine underground profitably at 2 grams per ton. Politics is the next P. This is a very simple slide. I don't know that it requires much explanation. The one thing I would say in addition about politics is that there is political risk everywhere, even in Canada. You know, there was the oil and gas royalties thing a few years ago where basically they nationalized everything. So you can't say, I'm not going to have any political risk in my portfolio. If you are of a sensitivity to political risk, that you want to have a no political risk jurisdiction and focus on that, then I suggest that you get out of this sector. It doesn't exist. This business is not for you. There's always the possibility of an unexpected turn of events, a bad election, the wrong party gets in power. It can happen in Canada. It may happen in British Columbia soon. It can happen anywhere, okay? So what we try to do, though, is if we're going to go to a riskier environment, and some are more risky than others, then we want to make sure the rewards are commensurate with the risk. And I'll leave it at that. Okay, paper. It's hard to have a good picture of paper. This is just a stock chart I picked because it was a win. But if you have, well, obviously the more paper you have out, the larger the float you have better liquidity, that's a good thing. But if there's too much paper out, you have to wonder, well, what happened to this company? You know, why do they have so much paper out? And the guys from Avion earlier this morning, this afternoon, were able to say, well, you know what? We had to either build our mine and move forward during the crisis in 2008 or fold up shop. You know, might as well go home. What are we going to do? So they bit the bullet. If there's a reason like that for the paper, I can understand and I can go forward as long as the value is there. But the red sign, it is a red sign. If a company if it's an exploration company just beginning to define a deposit or look for a deposit, and they've got hundreds of millions of shares out, that's a huge red sign. How did you get so much paper out? Why? And, you know, did you give it all in options and warrants to your buddies? For an exploration company, really 50 million shares out is good. If you're approaching production, if you're an advanced explorer, you've got your mine discovered, and you've had to spend money defining it, you know, between 50 and 100 million is good. If you're in production and you're only around 100 million shares out on the Canadian exchange, that's pretty good. Anything in the several hundred million shares, I need a really darn good reason how you got this way. And I want to know who bought at what price. I want to know if there's a large whack of shares. You know, if somebody has 50 million shares at 10 cents and it's trading at 50 cents now, that's a big concern to me. These are the kinds of things that you can actually discover. You don't have to be me. You don't even have to have management return your phone calls. You can go on SEDAR and download their financials. Or most companies will have them on their website, but the most recent ones often take a while. So you can get them from SEDAR. That's SEDAR. DAR.com. It's the Canadian regulator's website. You can get all the public disclosure documents from the companies there, and you can see what the share structure looks like and who the shareholders are. I'm never sure if this is going to work. Oh, okay. Financing. One of the first questions I ask on the financing is, well, obviously, do you have the money to do what you want to do? You heard me ask that from Yale earlier today. I said, do you have the money to deliver this? And he told me what they had the money to deliver. Then I want to know, how much skin in the game do you have? And if management owns, they might say, oh, we own 5%. Well, yeah, but did you get that as options that you were given as part of the options package? Or did you put money into the game? And if management hasn't put any of their own money in the game, I'm not quite as bold as Doug Casey. I won't get up and walk out of the room. But how many people have heard that story? Well, okay. We're tight on time. Ask me later. We'll tell the Doug Casey story. I won't get up and walk out of the room. But the chances of me recommending the company, if the management hasn't put their own cash in where they're asking investors to put cash, are pretty much zero. When it comes to financing, I want to see money in the bank, especially if we're worried about more economic trouble, another 2008 style upset. They're not going to be able to raise money if what we think is likely ahead actually comes to pass. If Doug Casey is right about the recovery not lasting long, the wheels may be coming off the economy even this year, going back into the double dip. People aren't talking about that. People are talking about the rosy recovery. Doug doesn't buy that. If he's right, and your company that you bought ends up with no cash in another 2008 type scenario, then you are going to be diluted to nothing, even if they succeed ultimately. You as an early shareholder in front of that catastrophe, financial fix, will be diluted to almost nothing. And if you're diluted 10 to 1 and the stock turns into a 10-bagger eventually, you only get out to where you started. Does that make sense? Watch out for that. So I want to see, under current circumstances, at least a year in the bank. 2 years makes me much happier, which, by the way, Exeter has. If they have less, then I'm thinking about private placements rather than open market. And if they have less and they might have a financing to offer, I like the Rick Rule mantra. I want to see a full warrant 2 years. And I'm okay with a little bit of dilution if I'm one of the ones who gets to have that extra option in the warrant to benefit on the upside. If anybody here is a qualified investor, if you're at that level and you're not taking part in private placements, you're missing the cream atop of the milk here. You're really missing the big upside. Promotion. This is one of the P's that people look at almost negatively sometimes. The word promoter is not a compliment. When we say, oh, that guy's a real promoter, that's taken to mean in our business that he has a lot of talk, but not a lot of walk. The rocks aren't worth the promotional hype. But actually, promotion is a positive in our view. If you've got the right people and you've got the right rocks, you need to get the story out. And there are times when you have guys who are geologists, engineers, they just don't understand that delivering good technical results is not going to get their share price to move. You have to be able to tell a story. You have to communicate it to the market. Enough on that. And then price, the final P. Oops, wait, are we missing a P? Oh my goodness, I am missing a P. The other one is push. This ties into promotion. My apologies, I'm missing a slide here. The push in a story is the deliverables. You heard me ask, if you were here in the previous sessions, what are you going to do over the next quarter or two? What are you going to bring to the market that's going to get them to revalue this, or what are the deliverables? And then, of course, you have the money to pay for it. So that's where your push is. We want to know, are there drill results ahead? Is there a feasibility study ahead? Is it the kind of thing that's going to make a difference in our shares? And this is important to remember, because ultimately, my purpose here is not to build mines. I would like to recommend good companies that succeed and actually build mines, create jobs, and do all these wonderful things. But what you guys have tasked me with is not to build a mine. My purpose for you is to recommend a stock that goes up. And so there needs to be push. It's not, and sometimes a stock goes up without merit, and I don't want to recommend something without merit. because that's just a crapshoot. But if something has merit and they can promote it properly and they have the push, the coming deliverables to the market, then we should see the stock respond. That's ultimately why I'm here. So we want to see good push. That's part of the 8 Ps. If a company has a great project, but the deliverables are a year away, then my thought is, okay, thank you very much. Let's talk in 6 months or 9 months. Okay, price. Price actually starts with the underlying commodity. It's not just the stock price. And you know, we talked about the Coulon project at Virginia. They have a very good, very high grade, very large base metals project in a great region. But it's base metals. And if you believe, as Doug Casey does, that the economy is going to turn around and head south soon, then you know, the price of the underlying commodity is something that says, let's stay away from this for a while. So that's really the place to start. The trend has to be your friend. The other thing on this, it sounds obvious. You guys have heard me talk before. I've heard this before. That, you know, the recipe of buy low, sell high. It seems so obvious that why do you even say that? Well, because how do you buy low? To buy something low, you have to buy something other people aren't buying. Maybe because they don't know, or maybe because they assign a higher political risk than you're willing to assign to it, or maybe because the market has misunderstood a result. You have to be a contrarian to buy low and sell high. If not, if you're buying what other people are buying, what you're really doing is buying high and hoping to sell higher, which can happen in a bull market. But it's a much riskier proposition than buying something that's actually undervalued. And we recently talked about something cheap enough can overcome almost any risk. And the example in hand was the Banrose story, which is currently our newest pick in the portfolio. But the funny thing about that is that Doug Casey recommended that stock 13 years ago because they had just had their primary asset confiscated by the government. You know, what kind of reason for that is that to recommend a stock? Well, of course, the stock cratered. And so if the stock was almost at zero, it's very easy to get a high multiple on almost zero. It's much harder to get a high multiple on a multi-billion-dollar company than it is on a $5 million company. So the way Doug likes to say it is, it's worth a punt. You know, if the stock is cheap enough, you can overcome almost any risk. So these are the 8 Ps. There's a few stories from there, and we're trying to get back on schedule, so I'm probably not going to tell you any more stories right now, but I will be around at the reception, and I will be around at the PDAC, and of course I will be at our conference in April in Florida, and I can tell you more. But this is what I do. This is my job. I go through all of these things in considerably more detail, obviously, than I can give you in a half an hour. And if something doesn't make it, you won't hear about it in the newsletter. So all of you who write those suggestions, you know, what about this company? What about this company? What about this company? We do get them. We do look at them. If we don't write about them, there's something in the 8 Ps that didn't work. Now, this doesn't necessarily mean it's a bad company. It could be on the price issue. It's multi-billion already or something, and we don't see a double in our usual time frame. It's not necessarily that it's a bad company. It's just not our profile. But that's what happens, and this is what I do. So thank you for listening, and if my colleague Marin is still here, I should turn the podium over to him.